All right, now we're going to look at what are called automatic stabilizers or built-in stabilizers. So these are simply changes in government spending and taxation that occur automatically without the deliberate action of Congress. So some examples of these are our tax system. Another one is the unemployment insurance system, as well as welfare spending or, welfare, right? Okay, so let's look at the tax system first. So how does the tax system act as an automatic stabilizer? Basically, when people's incomes and when businesses' profits fall, business activity slows down, so we start to enter maybe a recession. And as that happens, the government's tax revenues drop as well. Some economists consider this an automatic tax cuts, right? So if you make less money, you pay less in taxes. If you are a business and you make lower profits, you pay less in taxes. Well, recall that lower taxes help to boost the economy. So here we got, when we go into a recession, perhaps, it generally means that people's incomes go down. It means that businesses' profits go down, and so they pay fewer taxes. They pay less in taxes. And that acts to sort of boost try to boost their consumption spending and their investment spending. Okay, so in this way, it's automatic. The government doesn't have to make any decisions. It's just part of our tax system. Same thing with unemployment compensation and income transfer payments. So our unemployment insurance system has this automatic stabilizing effect as well. When we start to go in a recession, people start to lose their jobs, and when they lose their jobs, they become eligible for unemployment, which is income transfer payments from the government to help them get by as they look for other jobs. And so in this way, the government is basically increasing spending automatically when there's a recession and people start to ask for unemployment benefits. And so recently, this has been a pretty huge boost to aggregate demand currently because there's been an unprecedented number of people applying for unemployment benefits. Millions of people, tens of millions of people per week in the last couple of weeks here. So basically, again, to see how this is an automatic stabilizer, unemployment compensation reduces changes in people's disposable income so that even though they may lose their job, they still have, they lose less income than they would have without unemployment insurance. And so their disposable income remains positive, although at a slightly lower level. And so in a recession, when people lose their jobs, more people become eligible for income transfer payments, and we do not experience such a dramatic drop in disposable income, and therefore aggregate demand doesn't drop as much as it would otherwise. Now, the stabilizing impact of these is that these systems provide the ability to mitigate changes in disposable income, consumption, and the equilibrium level of real GDP. If disposable income is prevented from falling as much as it would otherwise in a recession, the downturn will be moderated. It'll be less severe. All right, so here we go. We've got unemployment compensation and income transfer payments as a function of real GDP. So when real GDP is lower and we go into a recession, these payments are higher. And when we have an increase in real GDP, more people are employed and these benefits are lower. And then we have tax revenues here. Okay, and so when the economy is doing poorly and in a recession, the government raises less revenue, and therefore we have a budget deficit. But when the economy is doing well, the government can raise more tax revenue, and we have a budget surplus where they're actually raising more money than they're spending. All right, so fiscal policy during normal times, quite frequently Congress ends up doing too little too late to help in the cases of a minor recession. And fiscal policy that generates repeated tax changes creates uncertainty, which we saw in that behavioral example can push the multiplier close to zero, meaning that there's actually no impact of government spending or fiscal policy. But during abnormal times, like we might be experiencing right now, fiscal policy can be quite effective in certain circumstances. So it was quite effective, or it could have been effective in the Great Depression. It turns out that the Great Depression was so bad because the government actually didn't know what to do because it hadn't experienced anything like that before, and it actually did all the wrong things. But it could have been that fiscal policy could have been used to stimulate aggregate demand. And we actually see this during times of war. So during World War II, when there was a huge increase in government spending, real GDP increased dramatically. We are facing sort of abnormal times right now, and the government has spent close to $3 trillion in just a matter of months. Huge, huge amounts of money. And so basically what they're trying to do is prevent us from going into another Great Depression. And as it turns out, there's sort of a soothing effect of Keynesian fiscal policy. And in the event of a severe downturn, as we may be facing right now, fiscal policy is, for the most part, always available. And knowing this may reassure consumers and investors, which I think we've seen, especially if you have been following the stock market at all. It has seemingly been responding positively to the fiscal policy response, in addition to the monetary policy response, which we'll talk about in a later chapter. But that's what the central bank does, is monetary policy. And so there's sort of this soothing effect, right? Consumers and investors see that the government is taking very strong actions, sort of alleviating any panic or stress that might otherwise cause us to go further into a recession or a Great Depression.